Can you see relevant activities will filter into that? But that causal relationship has to be explored. In your answer, you would be required to prove how your power actually has an impact on the final profit of the company, in simple terms now. All right? So this means if you're a preference shareholder and you get a preference dividend, how will your involvement have impacted on the final profit for the year, which will be declared as a dividend to the ordinary shareholders? That, can you see, cannot work. And that is why you've got to have that causal relationship. Whatever you do must have a direct impact on the outcome of this company's returns at the end of the year. All right, there must be a clear ability, the last bullet point, there must be a clear ability of the parent to use its power to affect the returns of the investee to which it's exposed. And that's what we've just spoken about. Is it possible to see the link between the parent's involvement and the variability in the outcome of this company's financial performance, in the financial period? If there is such a link, you're well on your way to then establishing control. All right, so you can see we have to look a bit deeper. If we move on to slide number 18, the steps that I recommend that you follow. Now, ladies and gentlemen, can you remember I spoke to you and I said you have to follow a 3-step approach. Now, mark this slide clearly as a 3-step approach, all right? Firstly, consider the activities of the company, all right? So that is where we start and we say, okay, these activities take place in the company. Now, which of them are the relevant activities? And we discuss that, and we actually prove that these are the relevant activities by showing that they have the biggest impact on the final financial performance of the company. So those that significantly affect the returns of the entity, those are the relevant activities. Now, we've spoken about that. The second one, evaluate the power instruments. Now, this was formerly the focus of IAS 27, like we discussed. The ability to govern, that is what we are actually going to explore in this area. Do you agree? So how do we direct these relevant activities? So what are you asking here with the power instruments? How am I physically involved? And that's why typically you would come across things like voting rights, etc., potential voting rights, agreements to govern, etc. Those are the things that we're looking for, the ability to govern. Look at my examples. Voting rights. The right to appoint directors to the board. Have you thought about that one? Who governs the relevant activities? Most often the board of directors, 99% of the time. Do you agree? Now the directors that get appointed by me will do what I want them to do in this business. Do you agree? So by me appointing the directors to the board of directors, that's a way of governing the company, because we know that the board of directors are directly involved in the relevant activities affecting the outcome. Very important. Okay. There I said decision-making rights, potential voting rights. Okay. Things like, those decisions that take place. Who plays the biggest role? Who determines the outcome? Who directs the relevant activities? And then lastly, we assess the returns. Returns can be positive or negative or both. For example, look at this, the dividends, the fees that I earn, okay, that are based on, for example, percentages, okay? Because if it's a fixed fee, there's no variability in the return. Do you agree? And then synergy, things like that. What is the benefit? How does my involvement contribute to that particular benefit that we're talking about, or that return? The more power, the more variability in returns. Remember that. Okay, now let's move on to slide number 19. Control is reassessed on an annual basis. This is important. You cannot establish control once off. You have to determine on an annual basis whether control still exists. And when you discuss control, that is something to mention, that it's got to be annually reassessed to make sure that circumstances have not changed. Can you see that had it only been based on voting rights, then that would not have needed to be reassessed. Do you agree? Because that's logical, all right? Because if it's still in place, control is still in place. But now that control is so much more than just the ability to govern, it's about the relevant activities. The relevant activities of the company could have changed during the past year. Do you agree? So those are the things that you need to assess. My power instruments might have changed. The variability of my returns might have changed. So that's why it's assessed on an annual basis. As the relevant activities change, control can change too. That's what we said. And just take note that special purpose entities, like we said, are now called structured entities per IFRS 10. So this is typically when you have let's say you create a very specific entity like a trust or another entity, a partnership, or whatever it is that you are creating there. Okay, a separate vehicle to who, an outsourcing happens to that specific activity. They get formed specifically to look after the debtors book of a financial institution. All right, so they've got a very specific purpose. Now, why is that so important? Because there's decision making, but only to a limited extent. Do you agree? The decision making through voting rights in a special purpose entity, which is now called a structured entity, the decision making there could mainly relate to the administration of that structured entity. And what do you realize then? That the structured entity's relevant activities are not affected by those voting rights. Do you agree? And that's why you will find that most often the relevant activities determined for the structured entity will be governed by agreement and not voting rights. So when you start looking at structured entities, it's very important to look at the terms and conditions according to which this entity was structured. Because there we will determine firstly what the relevant activities are and who can actually impact them through which power instruments, if at all. And that's why we'll be looking at contractual agreements rather than voting rights. Okay, so what I'm saying is that the real decision making through voting in a structured entity is not really most often aimed at the relevant activities. Okay, so they are based on irrelevant activities for our purposes. So once again, be very sure what the relevant activities are of a structured entity. Okay, let's move on and look at some aspects dealing with power on slide number 20. All right, existing rights that give an investor the current ability to direct the relevant activities. All right, so ladies and gentlemen, this concept of power is much more important than what most people realize, okay? Power isn't just something easy to consider. We must just attach some characteristics to our power instruments, existing rights. So I like to talk about the whole concept that they mention in the standard, substantive rights. They can be substantiated, they are realistic, they can practically be exercised, okay? So they must be substantive, it must be practical to exercise them, and guess what? You are the only person who can make that decision by looking at that information. I cannot tell you under which circumstances they will be substantive. You need to look at the information in the question, ask yourself, is it economically realistic that these power instruments can be exercised? For example, if there are potential voting rights. Do you agree? Okay, protective rights, we know by now, they do not provide power. Potential voting rights, very, very important. Why are they so important? Because they work differently in IFRS 10 than in IAS 27. Now, how is that different? Let's see. Potential voting rights need to be currently exercisable. That's how they are. That was the same to IAS 27. So when I prepare this assessment of whether I control the other company or not, at that stage, my potential voting rights must already be currently exercisable, okay? And must take into account the economic reality, i.e., is it practical to exercise? We should consider the financial ability and intention to exercise those potential voting rights. Now, IAS 27 told you, for example, to ignore the financial ability and to ignore the intention, relating to potential voting rights. Can you remember? That was a specific exclusion in IAS 27. That is not the case in IFRS 10. What happens here is that if I own, let's say 40%, I've got an example like this, but if I own 40% of a company's shares and then also 40% of the voting rights, and I have the option to acquire another 20%, then I can't just say, well, I have the option is currently exercisable, so I have controlled 60% of the voting rights. Okay, that would give me possible power. Do you agree? But then I have to go look at, do I have the financial ability And secondly, is it realistic, economically speaking, for me to go and exercise those options? All right. So, am I going to exercise them at a significant loss? Then they're deeply out of the money, then I'm not going to exercise them. Do you agree? So yes, I can potentially exercise them, but the economic reality is that I'm not going to, because I'm going to make too much of a loss. You see, so that is what I'm saying here. You need to take into account the reality. Not just can they be exercised, but also will they be exercised. So financial ability, intention of the holder of the options, all of those things have to be taken into account. Let's move on to slide number 21. Protective rights. When entering into a contract, okay, for example, we've spoken about this, certain terms and conditions exist, okay? Now these terms and conditions, they normally come to you in the small print of the agreement. Do you agree? So, and they protect that particular party under certain circumstances. So these rights only appear under those conditions and are therefore not substantive in all circumstances. Therefore, they're not seen as power. I think we've spoken about this enough. Let's move on to slide number 22. De facto control. This is what we said earlier. Power that exists with less than 50% of the voting rights. Okay? So you can be sitting in a position of 20% of the voting rights, but I might have de facto control. Now let's have a look. The parent owns 20% of the voting rights, and the remainder of the voting rights, the 80%, are spread over 2,000 shareholders countrywide. Now, once again, can you see the concept of the economic reality coming in here? What are the chances of getting all 2,000 of those shareholders together to come and exercise their 80% of the voting rights? Once again, I cannot give you a yes or a no answer. You must read the question. Now, I would say in those circumstances, it would be unlikely that those people will come together to come and vote. So you, with the biggest individual shareholding of 20%, you will then have control over that company because you have the biggest say regarding the voting rights. Do you agree? So the other 80%, they won't be there because maybe they own a 0.5% or a 1%. They're just in it to get a little dividend. They're not actively taking part in directing the relevant activities. Can you see that? All right, so we don't just look at 20% and say, no, it's not possible. Look at the economic reality. Then, contractual arrangement to direct, despite having only 20% of the voting rights. Okay, so you can see, let's say we had 80% in this company, 80% investment, and we sold 60%, therefore we're now only retaining a 20% investment. All right. Now, the new owners don't want to govern directly because they want to get familiar with the subsidiary that they've just acquired, etc. So what do? They enter into a 5-year contract with the previous parent and they say, you know what, you only own 20%, but you will be given the right to direct the relevant activities of this organization for a period of 5 years until we feel comfortable to take over from you. Can you see the economic reality? We only own 20%, but we are given the power to direct by means of, what is my power instrument here? The contractual arrangement. Okay, what is the outcome? The dividends that I'm going to earn for my 20% investment. Do you agree? What are the relevant activities? If it's a construction company or whatever, or a manufacturing company, those will probably be the relevant activities. How can I take part? Through the contractual arrangement where I direct how things are done in this particular business. And that is why I've got that causal link between what I do and the outcome being the returns of the company. Let's have a look. Potential voting rights being currently exercisable. So if I own 20% and I have another 40% share options, they are currently exercisable. Each of them, carries one vote with it. I have the financial ability to exercise them. I have the intention. It is possible to do them. I'm not going to exercise them at a significant loss. So the options are in the money, or deeply in the money, or at the money, then I will still exercise them, but I'm not going to exercise them if I, make a loss. Those are the considerations that we take into account when determining control. All right, let's move on to slide 22. Potential voting rights.